Welcome back everyone, Patrick here. Moving on to the next video, we're going to do an example dealing with double entry accounting. And this example, it's written out in the lecture notes, so you don't have to write this out. You can print those out. They're at the beginning of the section on the website. And if you notice in that example in the lecture notes, there's 13 transactions. Over here, I only have the first written. And I'm going to go over all 13. It's just I'm going to go through them one by one on the whiteboard just because there's not enough room to fit them. And as I mentioned in the overview video, we're going to be taking these transactions and inputting them into that flow chart, that accounting equation, and you can also print that out. It's also going to be at the beginning of the section on the site. There's 2 PDF files. So what we're going to do is we're going to go through these 13 transactions. It's a business that you started, and then we're going to provide a balance sheet at the end of the month. So we're going to have to net out all of these transactions. So I'm going to go through them one by one here, but then at the end, I'll show all the transactions in that same chart, all listed out. And then we can also tell from there how profitable was the business in the first month. What's the net income of it going to be? So all that's going to be done at the end. So let's focus on the transactions for now. So you start a lawn mowing business with $1,000. $500 is of your own money invested, and then $500 is borrowed from your parents. So to start this off, I'm going to actually draw out that chart. So we got the change of assets equals the change of liabilities plus the change in equity, but the change in equity is split up into the change in capital plus the change in retained earnings, but then the change in retained earnings is split up into revenue minus expenses, and then we're going to be subtracting the dividends at the end here. Right, so each of these transactions I'm going to input over here. So you start a lawn mowing business with $1,000. So this particular transaction, you can split it up into 2 lines, or you could do it in 1 line. If you did it in 1 line, well, $1,000, so you're going to get $1,000 cash, right? So that's going to be an asset, that's going to go up. And then $500 is of your own money, which would be the capital. And then $500 is borrowed from your parents, which would be a liability, like that. So that's if you did the transaction in 1 line, and then you can also take both of these 500s and split them up if you wanted to. So 500 would be of your own money, and then 500 would be from your parents, like that. So that's another way. So either or works. Notice that in both instances, the equation balances. We got 1,000 on the left side and then 500 on the right side. Moving on to the second transaction. So a business name is registered for $50 and paid with a credit card. So a business name is registered for $50. Now, when you first read this, you may think that that's an expense, right? You're spending money on the business. However, this is actually an asset. If you remember from the fundamental videos, we differentiated between assets and expenses. We said assets are going to be used in the future to generate revenue, while expenses are used now in this period to generate revenue. And if you think about it, a business name, it's going to be used for a prolonged time in the future, assuming that this business is a going concern. And so this business name, it's actually going to be an asset. Another way to think about it is that it's owned, quote unquote. So if you were to sell the business, you can also sell this business name. That would be an asset that's part of the business. It's an intangible asset, so it's not like inventory or cash, but nevertheless, it still is an asset. And we're going to get into talking about intangible assets in more detail in future chapters. But something like this $50, so that ends up being an asset. And then notice that you paid with a credit card. And so when you're paying with a credit card, that is a liability. You didn't use money, or you didn't use cash to pay it. You paid it with credit. And so that would increase your liabilities by $50. And so notice that it's balancing over here. Now, depending on your prof, depending on your textbook, I mentioned this in the fundamental videos as well, the way they differentiate assets and expenses may be different. They may use different definitions. They're all going to be kind of the same. So it's going to be an asset, for example, is going to be used in the future. It's going to provide an economic benefit in the future. It's owned, et cetera, et cetera. It's going to be within that wording. But you may have to take a transaction like this and adjust it to your profs or your textbook specific wording, right? But just in general, a business name that gets registered for a business ends up being an asset and not an expense. Now moving on to the third transaction. So at 10 cents a flyer, you buy 2,000 flyers and pay with cash. So if you're buying 2,000 flyers at 10 cents a flyer, if you multiply those, you're spending $200. And you're buying these flyers with cash. So we know the assets are going to go down by $200 for sure. The question is, are these flyers going to be calculated or inputted as an expense, or is it going to be an asset? So again, you ask yourself, are they being used now to generate revenue, or will they be used in the future? When will they be consumed? When they're being consumed, that's when you record it as an expense. Well, you're just buying the flyers for now. And so when they're going to be used is when they're going to be distributed. So when you buy these flyers, this $200 worth of flyers, it's actually going to be an asset. And then once you distribute them, then it becomes an expense. Okay, another way, if you sold this business, these flyers you can also sell as an asset that's part of the business. Now, you may not necessarily get the full price you pay for them if you sold the business for $200, but that is another topic with asset impairment that's a little bit more complex. But nevertheless, if you were to sell this business, assuming you'd get this same price that you paid for the flyers, you could sell the flyers with the business as well, right? So it's going to be an asset. So actually, assets go up by 200 because you're getting the flyers, and then assets also go down by 200 because you're spending cash. So it would be plus 200 and then minus 200. Or if you want to put it in one line, you could put plus 200 minus 200. Like that, right? And so notice it balances out because everything's netting out to zero on that left side. Now moving on to the fourth transaction, you buy a lawnmower for $400 with a credit card. And so a lawnmower, is that going to be an asset or an expense? And hopefully you could tell that it's going to be an asset. It's going to be used in the future to generate revenue. It's not necessarily being used right now. Right, so that would go up, the assets would go up by 400, and then you paid with a credit card, so your liabilities would go up by 400. Now with something like a lawnmower, this is classified, when we get into more detail later on in the course, this is classified as a fixed asset. And then as the lawnmower gets used, you can expense it, you could take depreciation on it. So you would have a depreciation expense every period, whether that would be every month or every year. So eventually, once it's being used over its useful life, then you can take expenses on it. But when you initially buy it, it is an asset. It is owned. So if you sold the company, you'd be able to sell the lawnmower with the company as well. That would be part of the asset. And so it's going to be used in the future to generate revenue, so it gets capitalized. If you remember that word, we use that in the fundamental videos. It gets classified as an asset, and because you paid with credit card, your liabilities are going up by 400 as well. Now moving on to the fifth transaction. So this one's a little tricky. So you purchase a top Kijiji ad for a month for $95 with a credit card. So again, with a credit card, we know our liabilities are going up by $95. Question is, this Kijiji ad, when you purchase it, is that going to be an asset or is it going to be an expense? Well, when you first purchase it, it's not being used yet. It's not being consumed. So this would actually be classified as an asset. And then once it expires after a month, at the end of the month, then you can expense it. It's kind of like when we bought the flyers for the $200, right? When we buy them, they're classified as an asset, and then once we distribute them, then they get expensed. Same thing with the Kijiji ad. So when we first buy it, it's an asset. It's going to be used in the future to generate revenue. And then once it expires, then we can expense it. It's been used up or it's been consumed. Right? Another way to think about it is if you sold this business, or even not even selling the business, you could sell this Kijiji ad potentially to someone else for maybe not the 95, but let's assume that you can sell it to someone for 95. You could sell it indirectly to someone. They wouldn't buy it from Kijiji. They could maybe buy it off you. They could take your account and then they could use the ad for whatever business that they have or whatever they want to advertise. Right? So you could take this and you could sell it. So that's another way to think about assets. Right? So it gets classified as an asset for $95 initially when you buy it.